call is open, and I have got the link over in the chat, which I will send again to everyone. If you have questions for the speaker, just please send them either through the Q&A at the bottom of your screen or through the chat. I know everyone there's a lot of you have the same questions, so go ahead, send them in. Everybody, we're here to learn today, so we'll get those over to our speakers and see what they think. So let's make sure we've got Warren about ready to come on board and share his screen. All right, there he is. All right, Steve, if you could connect Warren and get his presentation going. There we go.
All right, how's that?
That's great. We can see you, and I will throw this over to you.
Perfect. Sounds good. Thanks, Shelly. I appreciate it. And happy to be with you guys again. Thanks so much for inviting me to be a part of it. I've talked to you guys about cost segregation before, but the CARES Act has some pretty cool advantages that they haven't offered in a few years. And we're going to kind of throw that out so you can hear about it and see about it. And we'll see if we go from there. All right. So the main thing that we'll talk about the CARES Act just briefly, but just to kind of touch on a couple ideas is that generally what we do is help decrease your federal taxes and increase your cash flow. In the past, when we did a cost seg study for you, the end result was lower taxes. What the CARES Act does is bring in the idea of a refund back, and they haven't offered that in many years, and it's on the table now, so it's pretty cool. So that's the main concept that we're going to talk about today. And I'll kind of dive right in. Here's one of the big pieces that the CARES Act offers right now, and that is a loss carryback. Okay, so the CARES Act allows for the carryback of a net operating loss that arises in 2018, 19, or 20. What does that mean? What's a loss? Hey, I've got more expense than I have income. That's a loss on paper. Cost segregation also helps create a loss through depreciation expense. So you have a 5-year carryback rule. What does that mean? I'm going to walk through this example to show you what I'm talking about. John Smith has income for the past 5 years, and John has a loss in 2019. John called me and said, hey, do a cost segregation study for me. It generated, say, a $500,000 loss. He zeroed out his 2019 taxes, and he still had $425 in depreciation expense left over, that loss. So here's this example that the CARES Act says you can take that loss back to 2014 and use it to offset your income. It requires you to go back 5 years. So for example, you have $75,000 in income for 2014, $150,000 income for 2015, and $400,000 in income for 2016. You take that $425,000 loss and you zero out the $75,000 gain, the $150,000 gain, and half of your $400,000 gain for 2016. So what does that do? Since you've already paid taxes in those years, it generates a refund back from those years for you. And in this case, you apply different tax rates for the different years, $115,000 in refund that comes back in the 2019 tax year as a result of this loss carryback. A couple of notes about it is that it has to be active income. So it can't be that you make, let's say, have a doctor, you're a doctor and your main income is medical, and then you've got a self-storage investment on the side. It has to be your active income. If you're a real estate professional, it would work, or it has to be the active trade or business. So if you have 1 or 2 self-storage facilities and that's what you do, then we can do that and it created it. So it's active and passive rules. I get into a little bit of the weeds, sorry about that, but that's the biggest change the CARES Act brought about. A second one, and this probably is not gonna apply so much to all you guys that have self-storage, but I know many of you also have apartment complexes or office complexes, whatever that you resell or that you rent out, you lease out. So qualified improvement property, in 2017, the Congress said with the Tax Cuts and Jobs Act, we're going to get rid of restaurant improvements, retail improvements, and leasehold improvements. We're going to call it all QIP, Qualified Improvement Property. They wanted it to qualify for bonus depreciation, but they screwed up the law. The CARES Act changes that. The CARES Act allows you now to go back and apply bonus depreciation to basically an interior non-structural improvement. So if you did a renovation on a piece of property and you did things in the interior, and you might have done this to a self-storage facility, you can renovate the office, for example, anything that's interior non-structural that you did in the last quarter of 2017, 18, 19, or 20, and now qualifies for bonus depreciation. When you did those improvements, your CPA probably said, hey, I've got to capitalize this. You're not going to get a great benefit from it. You can retroactively go back now and capture that bonus depreciation using what's called a 3115 change of accounting form. You don't have to amend a return. And for the loss carryback, no need to amend a return as well. You can use this to go back and in both cases and capture some benefit that you might not have had. What does this do again? If you can capture bonus depreciation, that means, let's say I put a $200,000 interior improvement on a piece of property in 2019, and let's say 2018, and I've already filed my taxes. Your CPA probably capitalized that $200,000 and you're depreciating it over 15 or maybe 39 years. What you can do now, bonus depreciation allows you to go back and capture that $200,000 as a deduction to offset your income now. And so it applies to the 2019 tax year where you can capture that. You can't go, I guess you could amend and go do it for 17 or 18, but what most people are doing are applying it to 2019. I had one CPA that some of you guys know that gave a situation to me where he said, he's probably going to apply it in 2020 using a 3115 change of accounting form because he's already filed client taxes. But so again, lower taxes is what that does for you. The last one is if you have a loss from rentals, the Congress with the CARES Act took away some limits that you had. In the past, if you have a loss on a rental, you could only use it against your rental income or your self-storage income or whatever that might be. If you have a loss on, I say a rental, I apologize, a loss on real estate, period. It doesn't have to be a rental. You can use it now to offset income from other sources. Let's say the stock market, for example. They put some limits on it, and the CARES Act temporarily suspended those limits. It was, you can only use a loss to offset 250,000, a single 500,000 jointly. Now you can use it for all of that. So this is not going to apply to as many people, but I just like to toss it out there because, if you made a lot of money and you're looking for ways to offset it, this is one way that you can offset it, and it's not kept in a separate bucket, so to speak. So we kind of, the loss carryback was the big piece that you guys need to be aware about, and QIP. Now I'll kind of get into explaining cost seg a little bit and how cost seg helps. Now we've done work for the Lusks. We've done some work for Derek Lafargue. I've looked at Bill Humble's properties and for him. So, all of this is something that you guys can apply for. Normally what we did, it just zeroed out your taxes. Now what we bring to the table is that the CARES Act allows you to potentially get a refund back. And so, a quick overview of cost seg, anybody that's recently purchased or built, someone who's owned a building for many years, an owner or tenant who's paid for past improvements, even in estate situations, it works. We've had a situation where, father owns a building, we do a cost seg for him, he passes away, it goes to the kids. What happens is the building goes into an estate, it gets reappraised, and there's a step up in basis, and the new value, it resets depreciation for the kids. So we've actually done cost segs in the same year for father and kids on two different tax returns. Kind of crazy how that works. And even triple net tenants. Self-storage is a great candidate for it. How does it work? What we do, real quickly, the TPRS came out in 2014, and I did a whole seminar with Leonard, is it Haskins? I'm drawing a blank on his last name, a CPA that Leonard and I did, and we had about 25 of you guys there. But the TPRs are the tax law that allows you to expense or capitalize. You can expense a repair or capitalize an improvement, and the TPRs kind of came out in 2014 to solidify a solid network for everyone to use that for. a solid system. There's a lot of benefits to it, but it's a massive tax law, so it's misunderstood. So that's a great one for us to work with you there. The Tax Cuts and Jobs Act came out in 2017. That allowed for bonus depreciation, and I'll explain that briefly. And then it also allowed for QIP, but they messed up the definition. The CARES Act gives you a loss carryback, and it allows you now, they fixed QIP, so QIP qualifies now for bonus depreciation. Anyway, cost seg is a foundation to that because it gives you input to be able to capture these items. What is cost segregation? The quick version, the IRS says you can depreciate a building two ways, straight line over 39 years, or you can break it out into different buckets. And we have a 5-year bucket, a 15-year bucket, and now we have a 15-year QIP bucket, a 39-year bucket. If you can depreciate items faster, it offsets your income quicker. So, you know, instead of getting 1/39th every year for 39 years, you're depreciating things 5, 7, 15 years. And that in the years after a study, it gives you lower income taxes. Now, in the past, I said lower income taxes. Today, it might give you even a refund back. What's the benchmark? 30 to 80,000 per million in cost. So if you have $1 million self-storage facility and we can generate a $300,000 deduction for you, about 30% of the self-storage facility, multiply that times a 37% tax bracket, it gives you $111,000 in true tax savings. So pretty significant. And we do it for buildings and tenant improvements as small as 200,000 even. What are the types of things we're doing in a self-storage facility? We're doing your interior doors and your movable partitions. We've actually seen some court cases and IRS regulations that exterior doors cannot be taken for 5 years. So we don't do that. Maybe somebody that's aggressive might, but other things in the self-storage facility, your bathrooms are going to have countertops. You know, your office is going to have countertops. You might have flooring. You might have an apartment for someone who manages it that lives there. All those different types of things within that. Your security system, specialty lighting. I know some of you guys have wine caves. The air conditioner used to specialize in the wine cave is a 5-year asset. So all of those, you can kind of see the different types of things that break into shorter class lives. From a 15-year asset, landscaping, hardscaping, paving, fencing, the parking lot, you know, everything outside is a 15-year asset. And the spreadsheet kind of shows you the details, or excuse me, the graph shows you the details. Straight line is the blue line. You know, you get a straight amount of depreciation over the life of the property. The red line would be normally cost seg without bonus depreciation or without the CARES Act. You get a big shot of it for the first 5 years, and then 5 to 15, you get a big bump as well, and then it acts like straight line. And the green line is bonus depreciation, kind of where we are now. When you do a cost seg, you get all of the benefit immediately, and then the remainder of your property kind of runs on a straight line number. So let's kind of bring this full circle now. Look at the CARES Act, and here's an example. A $4 million strip center, you could just as well say a $4 million self-storage facility. You decide to apply cost segregation to it today. Maybe you've owned it for 4 or 5 years and never did a cost seg study. Maybe you just purchased it or just built it. Our cost seg study generates a $575,000 deduction for you in 2019. You use that deduction to offset $150,000 in gain, $150,000 in income, and you zero out your 2019 liability and you have left over. The CARES Act now allows you to create that NOL that you can use as a loss carryback. You apply that back to 2014 and it offsets taxes you've already paid for 14, 15, and 16. And the end result is you get a refund back. This flows from the business entity. You would get a partnership or a K1, and the loss carryback happens at the individual level. So even if you've just bought or built a self-storage facility in the past few years, it would go back to offset your income from your personal on a prior year. And again, the CARES Act says you can do this for 18, 19, or 20. If you did it to 18, most people I would assume have filed their taxes. That's going to involve amendments. If you haven't filed taxes for 19, no amendments are needed. You could also do this in 2020. And it goes back from the year that you applied to. So if you did it in 19, it goes to 2014. If you did it 18, it goes down to 13. And if you do it in 2020, it applies to 2015. Why? That gives you the ability to choose a year where you may have had a huge gain. If you made a ton of money in 2013, it may be worth amending the return and going back and addressing that. Great thing to talk to your tax professional about. Really would encourage you guys to do that. A couple of examples. The two on the left are self-storage. Client has a 2017 purchase of just under $1 million for a non-climate controlled self-storage, $45,000 in tax savings. These are some of our actual numbers. 2018 construction on a $3.6 million climate controlled self-storage facility, a $569,000 tax savings. You know, again, why is this important? If you can generate a tax savings of $569,000, you're probably not paying that this year. Now you've got the ability to do a loss carryback and get a refund back on a prior year. So pretty significant. And you can see why Congress has done it. The CARES Act allows for, you know, the PPP loans that a lot of people have chased. That's got a finite limit. This applies to anybody that owns real estate. If it's passive income, you can't do the loss carryback, but you can still reduce taxes. If it's active income, you have the opportunity of doing a loss carryback. Here's a dental office. Just kind of shows you a different type of facility. If you own an office complex, maybe this would apply. A 2008 purchase, $1 million shell. The dentist went in and put $450,000 of improvements in it. We did a cost X study for him in 2017 on this, and he still got a $70,000 tax event. And this last one, you know, 12 locations, created a deduction of $5.3 million and a $2.1 million tax event. This client, he did this when the law did not offer a loss carryback. So he's been zeroing out his tax liability going forward for several years. He did this, I think, in 2017 or 18. He recently called me and said, I purchased 3 new buildings, but I still have a loss from the work that you guys did for me. Is there a way for me to get a refund back? Well, he can use the prior loss to zero out his 2019 tax liability. He can cost seg the new 3 offices that he's purchased, and he can do a loss carryback with that. So there's lots of creative ways that you can work with it. You know, really important to talk to your CPA about it. Here's a link, and I'll try to put it in the chat at some point. I'll send it to Shelly, or I'll drop it in the chat after the talk. If you guys want a pre-analysis, we can very simply create a pre-analysis for you if you fill out the form that this link points to, or if you send us a depreciation schedule. I'll never forget, Bill Humble sent me his depreciation schedule and said, hey, Warren, why don't you run the numbers for me and see if there's some kind of benefit for me? And I went back to him and said, whoever your CPA is, he's a rock star. He has done everything you could possibly do. There's nothing else we could capture for you. It turned out to be Leonard, a CPA there in Little Rock, and he's called me and asked me to do some work for him. So, and he's a great benefit and asset for me. Sometimes if I have a question that I need answered, I can call him and we can bounce tax law off of each other to get to the right answer. But, you know, a couple other things I'll just point out. If you've done renovations in 2019 or 20, realize that if you're tearing things out and throwing them in the trash, that you have the ability to write them off. In the self-storage world, we see it a lot in a roof maybe, or in LED lighting, maybe in your doors. You know, you've been depreciating your building straight line, and your doors are a 39-year asset, but you've only owned the building for 10 years and you're throwing them out. You have 29 years of life remaining, 29 years remaining on the lights, 29. So you have the ability to write that down. So we go in and quantify for you and your tax professional, what's the value of that item you're throwing in the trash. If it's a roof or an HVAC, a CPA can do that. They don't need us for that. If it's wiring and in the walls and electrical and it's sheetrock and studs, that's when a firm would call us out. And kind of 2 things to be aware of that is that if you had a renovation, you have to capture that particular tax event in the same year that you do pay your taxes, or you lose the ability. In other words, if I did a big renovation on a piece of property in 2019, I have to capture a partial asset disposition when I file my 2019 taxes. If I wait till 2020, I lose the ability to do that. And real simple process to get there. And it's a tax savings at the time of sale, because it's reducing your basis. So when you sell a property, it's reducing the amount you're taxed at your personal rate and increasing the amount that you're taxed at capital gains, which is a lower rate. So did you renovate this year? If so, ask your tax professional, or if it was a big one, give us a call and we can run the numbers for you. This is just an example of an auto dealership where they did it. They had a $130,000 tax event from a cost seg on the original building, a $50,000 tax event from the demolition, the partial asset disposition, $126,000 tax event from the renovations, a $300,000 tax event. And that just kind of gives you an idea of how it works. So a couple of last things, just to explain what bonus depreciation is again. Bonus depreciation means anything that is identified of a 20-year life or less qualifies for bonus depreciation. Bob was talking about trucks. If you have a truck that you own, you can apply bonus depreciation if you bought it in one of the years where bonus applies. And your CPA would know about that. For a building, you need a cost seg to break that building out into the shorter class lives, and then you can apply bonus depreciation to the 5, 7, and 15-year assets. So anything that was bought or built after September 27, 2017 qualifies for bonus depreciation. So if you want to look into this loss carryback and you've never done a cost seg study and you've got a building that is only a few years old, that's a great candidate for you to be able to run a cost seg on, then talk to your tax pro about doing a loss carryback. And again, rather than the benefit being spread out over 5 years, you get the benefit immediately. QIP, again, any kind of interior improvement, what the CARES Act did was it redefined it as a 15-year asset, and that made it fit this definition of bonus depreciation. So any renovation you've done, same time frame after September 27, 2017 until now, it qualifies for bonus depreciation. You can capture it without amending the return with a 3115 change of accounting form. And this just kind of shows some of the assets of how bonus depreciation hits. If you see the fourth or fifth item down the line is the self-storage facility, 2.7 million. Normally, you would have done a cost seg and got 40,000 in benefit in year one, and a total of 219,000 in benefit over 5 years. Now, that last column is the benefit that you get, a pretty significant number. And in the self-storage world, we see that it's self-storage, particularly if it's climate controlled, it's very high on our range of items we can get. Sometimes it's between 30 and 40% of the cost of the building is able to be put into a shorter class lot. So a couple of filing questions for you guys. Hey, I've already filed my taxes for 2019. Can I still benefit from this? Let's say you have an older building. The term is called an automatic extension. You don't have to amend the return if it's an older building. You file a 3115 form and you have until you file your 2020 taxes to capture that. So if that's the case for you, you could do a cost seg study, apply it to your building, and then you could do the whole same loss carryback process. Hey, I've already filed my taxes, but I have a new purchase, a 2019 acquisition. In that case, you would have to amend a return and file a 3115 form, and you have until September or October to do this. And then, hey, I extended, can I still capture this? Absolutely. There's still time to do a cost seg study before the September or October deadlines. You could do a cost seg study, get it done, apply it to your 2019 taxes. And what's going to happen when you file an estimate, you typically have to pay your taxes ahead of time. So now you're going to get a refund back as a result of that because you've already paid your taxes. So do a cost seg study, apply it to your tax returns, and since you paid estimated, you're going to get something back from it. Or you could do it and apply it to 2020 and decrease your quarterly taxes rather than amend a return. So all kinds of benefits of how it plays out. This is just an example of a case study we did for a client. They were a restaurant owner. It was back in 2008, and the economy took a dip just like it is today. They heard about us. We did a cost seg study for them, and it zeroed out $70,000 in tax liability for them. They were a restaurant, so just like today, people weren't going out as much. They weren't making as much money. And they've called us and said, hey, you guys saved us. We probably would have had to close our second location if these taxes would have hit and we would have had to pay for it. So it's an opportunity to free up cash flow in this current business climate and in this current crazy corona. It's always been around, cost seg has, but the CARES Act, again, makes it a little sweeter because it allows you to capture bonus depreciation on it. Shelly, I'll kind of prep you if any questions. These are some of the hesitations we kind of get sometimes, but hey, my CPA has already done this. It's easy for us to run the numbers. We don't charge a dime for it. We oftentimes will run a pre-analysis. All we need is a depreciation schedule to do it. And, or, give us what you paid for it, what type of building it is. Hey, I've got 70% climate and 30% non-climate. And, from that, you kind of go from there. But, so we run the numbers, and then it gives us something to talk about with your accountant. And we regularly do that. We don't move. We don't do tax returns. We really work closely with a lot of CPAs. So we would then use this pre-analysis to bring it up to your CPA and yourself and kind of talk through it. I don't want to trigger an audit is a concern sometimes people give us. Cost segregation has been a while. It's been around a while. It hasn't triggered audits in the past. And just so that you know, we've done somewhere in the neighborhood of 22,000 studies. I need to update my slide. We've been around 18 years and 22,000 studies and never triggered an audit. We have had to knock on my wooden table here in the kitchen. We've had to defend our work or represent our work in about a dozen cases. And in every case that we had happy client and happy IRS. You might ask, hey, is this loss carryback or refund type of thing going to generate an audit? Well, in 2008-9, when the economy took a dip, Congress did the same thing. They allowed you to do these loss carrybacks to generate cash flow. I mean, they get it. They realize that people are having difficulties. And so we don't expect it to generate any kind of audits as well. We think, that's not going to happen. We actually ran it by 2 or 3 CPAs that we know well, and the CPAs all said, no, it should be great. Couple of quotes from the Journal of Accountancy, which is the National Association of CPAs, their journal, that just said, hey, cost seg and these things are been around a while and they're proven strategies. So why would you not want to do a cost seg study, or why would you not want to do some of this? If you're going to sell a property fairly quickly, you have to deal with what's called recapture. So we would say it's probably not a great idea to do it. But how do you address recapture, and how can you use a 1031 to your advantage? What is recapture? Basically, the depreciation that you take out when you sell a property, the IRS wants it back. It's a loan basically that they're giving you for a period of time, and so it's called recapture. There's a more technical way to look at it, but so one way of addressing recapture is diminished value, and even if you don't do a cost seg study and your building is fully depreciated out, if you sell it, recapture is still a part of the picture. So a diminished value. Let's say I've owned a building 10 years and I did a cost seg study, and parts of my property are in the 5 and 15-year buckets. Let's take the 5-year assets, for example. Let's take my carpeting, for example. If I have a building for 10 years and my carpeting is a 5-year asset, you can say, hey, the carpeting is fully depreciated out or mostly depreciated out. I still have it, so there's some value for me. So when you sell that property, you can assign a diminished value to the things that you have to pay recapture on, and assign a higher value to the things that are structural that you don't have recapture on. So that's kind of how you can do that. That's one way. We've actually done that for a couple of CPAs and kind of walked them through that process. It's something the CPA does themselves, but we can do, and it doesn't have any kind of requirement on the buyer. You have no kind of issues there. It's only on the seller's books. The other thing that many people do to offset recapture, I actually had this conversation, I think, with Derek when we met at the country club, and Leonard and I were doing the presentation for you guys. But if you sell one property and you have to pay the taxes on that, you can buy another property and do a cost seg on that new property, and that can offset your gain or offset the taxes from the first property. So that's a simple way to do it. The other way that's a little more complex is a 1031 exchange. Hey, I'm trading one property for another to defer my taxes. Well, the Tax Cuts and Jobs Act changed the law, so the 5-year assets don't flow through a 1031 exchange anymore, but most of the 15-year assets do. What we see people doing is they do a 1031 exchange, trade one property for the other, but they make sure that they have a little bit of basis in the second property, and they ask us to cost seg that second property. And that offsets the recapture that doesn't flow through a 1031 exchange. So the hint on that is make sure you have a basis in the new property. Make sure it's not a 0-0 trade that shows up on your books, but you've got a trade where you might have $500,000, that shows up on your books that you can appreciate. You can cost seg that, and you can offset the 1031 recapture that you had to address. How do we run an analysis for you guys? It's easy for us. We provide a no-cost predictive analysis. All we need is a depreciation schedule, or what's the type of building, your cost without land, the year and month you acquired it, and the address. And we can create that. And that link that I'll put into the chat box a little bit later allows you to click on that link, and you can fill that data out and shoot it to us, or you can send a pre-analysis for us. I do want to open it up for questions, Shelley, if anybody has any. I haven't been looking at the Q&A or the chat to see if there's any in there. There it is. Any questions for Warren? Post them here or in the Q&A. Perfect. So
Sorry, Warren, I had myself on mute. Okay. Yeah, Warren, if you want to post that link where they can go fill out the information in the webinar chat, that would be great. That way they've got it right here. And then otherwise, if we don't have any other questions come in, then we can actually go ahead and start our break a little bit early and move over to the virtual vendor hall, which, sorry, my video's off. Okay, we can go ahead and move over to the virtual vendor hall and start that break. Yeah.
Hey, Shelly, if you don't want to make that move, I can bring up commonly asked questions if you want to do that. Your call.
Yeah, do that. That'd be great. Let's do some commonly asked questions.
So commonly asked questions, hey, I've owned my building for a while. Can I still do a cost seg study on the building? Absolutely. You know, you don't have to amend any returns. You file what's called the 3115 change of accounting form. Easy process to do. Another question someone might ask is hey, do you do other assets besides self-storage? Absolutely. Any kind of commercial building. I know many of you guys are investors in other types of property, apartment complexes, office buildings, you know, you name it. We can do those types of properties. Somebody, an objection or a question that somebody offered me one time, they said, hey, this sounds like it's really tax technical. Suppose I just wanted to introduce you to my CPA and you have that conversation with them. Absolutely. You know, and it's kind of shocked me that not every CPA is kind of up on the CARES Act change, because the loss carryback is a pretty big thing. But I found that not every CPAs are familiar with the loss carryback, but they don't always realize that the CARES Act opened that up again. So a conversation with a CPA is a great thing that we do on a regular, you know, thing and a regular basis with those guys. So really encourage you guys to look at that and to think about that. I'm going to stop sharing my screen so I can put the link up there, Shelly. So if you've got something else you want to show on your screen.
That's great.
Did it stop?
I can still see you, but that part doesn't matter. You can still post the link over in the chat so people can get access straight to that.
That's funny. It's saying it's not shared. The CARES Act questions, you know, things that have come up with the CARES Act is the difference between active and passive income. If your main revenue is from your self-storage business or maybe from, you know, owning properties, then all this stuff applies to you. If self-storage or a building is an investment for you and you have a main source of revenue from another area, it's referred to as passive income. You can still do a cost segregation study and offset the taxes on that passive income but you can't use it as a loss carryback. So I think that question has come up a good bit. People have asked again about QIP. Do you have to, you know, hey, I did a renovation in 18. Can I, you know, go back and capture that? Yeah, you don't have to amend a return, and that one works as well. I'm gonna see if I can pull up that link and put it in the chat. If anybody is interested in us running the numbers for you, we'll do that for you.
Yeah, we actually had two people ask if the PowerPoints and the video is going to be available pretty soon. So I can definitely get that over to them.
Perfect. Yeah, that's great. I'll make sure Shelly has a copy that you can share with you guys. And there's the link that I just put on the chat side of things. And yeah, absolutely. If you have any questions, feel free to call me. I stopped sharing my screen again, but my contact information is in the PowerPoint, and Shelly knows how to get me, as do many of your board members. So feel free to ask those guys and they'll point you to us.
Absolutely. All right. Thanks, Warren. I guess we'll see you over in the vendor hall.
You got it. Don Little is on our team. He's over there now, but I'll go join him as well. Thank you so much, guys. Appreciate you having me.
Bye, Warren. Thanks again. All right. That was Warren Dazio with Cost Segregation.